Welcome back to ciLiving. The University of Illinois Community Credit Union stands out by consistently showing up for customers and the greater community. They are sponsoring our segment today, and here are Sheri Shannon and Kasie Woodworth. Welcome back. Thank you so much for joining us.
Yes, thanks for having us.
All right, so Kasie, I see you've brought a little bit of a game here. So what are we doing today?
We're going to spin. You're going to ask a couple questions, and it's just pretty much answering a couple questions about mortgages that people call and have.
All right, excellent. Here we go. I love when we can have a game and a spinning wheel. So the first one looks like it's actually two questions, starting with, what is the difference between an appraisal and an inspection?
Yep, great question. So an appraisal is actually something that is done for by your lender to make sure that your home is appraising for what it's asking for. An inspection is something that the buyer can actually do on their own behalf if they'd like to. An inspector comes in and inspects the home, and it's something that the lender actually doesn't even want to see, so it's just more on the buyer's behalf if they want to do it.
So that's kind of more to find out if the house has anything that you maybe want to get fixed before you go through with the sale, whereas the appraisal has more to do with the financial side of it.
That's correct. Yeah, definitely.
Perfect. And then the other question is, do I need a realtor?
Oh, that's a great question. A lot of people ask that, and we definitely recommend as a lender that you get a realtor. There's lots of great local realtors in town that we do highly recommend. So if there is anybody that you're wanting, we can definitely recommend those to you.
And if somebody already kind of knows the person who they're buying from or something like that and doesn't want to use a realtor, is there something that they should do instead?
Yeah, if somebody chooses not to use a realtor, we still highly recommend using a real estate attorney. That way they can go over all the documents with you and be able to answer some of those questions that they will better have knowledge of.
Right. And I know, Sheri, you're able to answer a lot of questions at the credit union, but sometimes there's things that you need to fill in, right?
For me,
well,
as far as
like if you have questions in general about mortgages, you can come to the credit union.
Oh,
but
yes,
then
absolutely. But we always refer to our mortgage experts. But there is a lot. Most of our staff can help our members understand some of the basics about a mortgage if they're thinking about it. But typically, we like to refer all of our members to Kasie or Phil. They're on our website. You can go out to uoficreditunion.org to reach them.
For those more specific questions, like what we have here
Yes.
on our magic wheel of games. All right. So what do we have?
I think it's going back to the same one. We
Oh, same one? All right. Missing peg. All right. So let's see, what does that say? Oh, how long is a pre-approval good for? That's a great one.
Yeah,
that's
so
a really good one.
it is. So we have you start off by filling out the application online. We usually say that pre-approval process takes about 1 to 2 days to get you pre-approved. As soon as we give you that pre-approval letter, it's good for 90 days.
Okay.
90 days specifically because that's how good your hard credit pull is going to be through that. So in that 90-day time frame is when you'll home shop.
Perfect.
Quick question
Yes.
based on that. Sorry, Kasie.
Yeah.
As a financial coach, a lot of times I get a lot of my clients asking me, what do I need to do to prepare my credit? So if I've done a pre-approval, should I apply for any additional credit during that time?
That is a very great question. No, you should not. So what will happen is if you apply for additional credit and you were to take out that line of credit, that is going to increase your debt.
I see.
That is something that we do look at is your debt to income ratio when it comes to qualifying for buying a home. So that original credit pull we have, if it does not have that debt on there, and then we go in 2-3 weeks before closing, we do another credit pull to reinsure that everything is still the same. So if that new debt is showing up on there, it can make your debt to income ratio increase, which could also quite maybe make you not qualify anymore.
That's a really good point then. So essentially, once that has been done, you want to make sure that it stays the same so that there are no surprises as you get closer to closing.
Correct, yeah. When we pull your credit, please do not apply for a car loan. Don't get a credit card. Wait until after you close on your new mortgage.
Eat ramen until it's time to close on the house. All right, and so we just talked a little bit about credit. What about down payment? So what are we looking at down payment wise?
That's a great question because a lot of people think you have to put 20% down. You actually do not. As a first-time home buyer, you can put down as little as 3% for a conventional fixed-rate mortgage, which is awesome. We at the credit union have a promotion that you can also put down 0% down for a first-time home buyer. for also a conventional fixed rate mortgage too. There's some guidelines that we'll look at to see if you qualify, so that's why we have you apply online so we can break that down for you. But as a first-time homebuyer, you can put down as little as 0% with us with our new program, 3% down, and then you can look at putting 20% down if you're wanting to waive that PMI, which is private mortgage insurance. That is added onto your monthly payment. So if you put down 20% or more, that PMI will fall off and you won't have to have that.
I see. So then that's if you're doing either the 0% or the 3%, then you would have that extra. That's more of like a kind of insurance so that it's like an insurance for the loan or something. What exactly is that PMI?
Yeah, correct. It's kind of a lender insurance just to make sure that if you're not putting down more than 20%, that extra insurance is being added on. But once your loan hits 80% loan to value, that PMI will fall off automatically.
I see. So then it just goes away.
Yep, it just
goes away
disappears.
magically.
Yes.
All right, let's spin again and see what else we have. So we talked about how long a pre-approval is good for. What do you have to do to qualify? What things are you looking for?
Yeah, so number one thing we are looking for is credit. So we are going to have that hard credit pull. We pull through all three of the credit bureaus, and we want your credit to be a 620 or above.
Okay.
So that's number one. Number two, we are going to look at your debt to income ratio. So we're going to get all of your pay stubs, your W-2s, tax returns. We'll go over that, and then that's where that hard credit pull will come into place too, because it'll show all your debt. So we look at your debt to income ratio as well, and then we want you to see having maybe a little bit of funds, because there are closing costs that are attached to the down payment. So even if you're not bringing a down payment because you qualify for that 0%, you still need to have some funds for the closing costs. So those are the three main things that we will look at when you are qualifying. If you do apply and you do need some credit counseling, our partnership program is great to reach out to as well. They have a program called Coffee, and Coffee can definitely help with that to help build your credit up and to show you what you need to do to work on it.
Wonderful. Well, this has been really helpful. Thank you so much for all of this information and for bringing us this fun game and for sponsoring today's segment.
Yes, thanks for having
Jaclyn.
us.
We love
yes.
being here. Thank you.